Hello friends, today I'm standing here to taking a seminar on the topic risk return analysis of shares. And first we going to discuss about what is shares. A share is a single unit of ownership in a company or financial asset. When you buy a shares in a company, you become part of an owner of that firm. And people who own shares in a company are called shareholders or stockholders. Shares are unit of ownership interest in an corporation or financial assets that provide for equal distribution of any profit if any are declined in the form of dividend. And shares have mainly two types, equity shares and preference shares. Equity shares are also known as ordinary shares, while preference shares enjoy the benefit of receiving their dividend distribution first. The equity shares enjoy voting right in merger companies' decisions, including merger and acquisitions. And investing in shares, like any investment, comes with a certain amount of risk. The primary risk of investing in shares that can result or loss of capital, unexpected events outside of your control, or negative developments within the companies can significantly affect the share price and the volume of your portfolio. Next, we're going to discuss about what is risk. Risk in traditional time is viewed as a negative. Webster Dictionary defines risk as exposing to danger or hazardous. The Chinese symbols of risk reproduced below give a much better describing of risk. The first symbol is the symbol of danger, while the second is the symbol for opportunity, making risk a mix of danger and opportunity. Suppose you would invest in a stock or shares that would either return you 15% or a loss of everything. Also suppose the chance of lose everything is 1% and the chance of earning is 99%. Therefore, the risk associated with the investment is 1% as the 1% is the chance of losing everything. Next, we go on to discuss about type of risk. Type of risk in finance is mainly two types: systematic risk and unsystematic risk. Under the systematic risk are mainly three type risk. The first one is market risk, and second one is rate risk, and third one is inflationary risk. Under the interest rate risk are also two type risk: the price risk, and the second one is reinvestment risk. And under the inflationary risk also have two type risk: the demand inflation risk and cost inflation risk. And come under to the unsystematic risk, they have also mainly three types. First one is business risk, and second one is financial risk, and third one is operational risk. And next we discussing about the return analysis. Return is an expected return on investment of stock or shares, is that the return that individuals feel is most likely to occur based on the currently available information. Returns are greater than the rate of inflation. An investor will look forward to getting comprehensive by way an expected return based on three factors. First one is risk involved, second one is duration of investment or the time value of money, third one is expected price level or inflation. Example, investment in stock or shares return based on the individual's expected as well as the future expected price. Next, we go on to discussing about the risk and return trade-off. Investors make investment with the object of earning some tangible benefits. Low risk leads to low return. For instance, in case of government securities, while the rate of return is low and the risk of defaulting is also low. Higher risk leads higher potential returns but may also leads to high losses. And the rate of return and investment can be calculated using the following formula: is that the return is equal to amount received minus amount invested into 100 divided by amount invested. And this is the graphical relationship between the risk and return. And in one side we can see the return, and another side we can to see the standard deviation of the risk. and inside the graph we can see the red light, and in the line shows that the low risk is indicating that the low return, and also high risk is providing high potential risk or high standard deviation. And this is the sum result which is based on the study of risk and return. The first one is, since equity shares earning a much higher return but the higher risk, it would be nice if we would invest and earn higher return but reduce the risk associated with the such investments. And investing in an portfolio is of securities can help manage risk. And portfolio is a collection of financial assets by investors. Stock or shares offering a higher likely return also have higher probabilities of total loss. And portfolio theory defines investment risk in an measurable way and relates it to its expected level of return and investment. And the risk return relationship, generally the higher the potential return of investment, the higher risk. There is no guarantee that you will actually get the higher return by accepting more risk. Next, we going to discuss about what is risk return analysis. Risk return analysis efficient portfolios, those which is provide a maximum return on average for a given level of portfolio risk. It examines investment opportunities in a time of familiar to the financial predators and the risk and return of an investment portfolio. And risk return analysis is comparing with the equity shares that the equity shareholders is an actual owners of the company or bank. The risk and return analysis mainly functions of this project, and the meaning risk and return as follows that risk refers to the possibility that the actual outcome of an investment will refers from expected outcome. Next, we go to discuss about comparative analysis of risk and return models. They have mainly five models. First one is the capital asset pricing model. Second one is APM. Third one is multi-factor model. Fourth one is proxy model. Fifth one is accounting and debit based model. For investments with the equity risk, the risk is best measured by looking at the variance of actual returns surrounding the expected return. In the CAPM, exposure to market risk is measured by the market beta. The APM and the multi-factor models allows the examining in the multiple source of market risk and estimate the betas for the investment related to each source. Regression for or the proxy models for the risk looking for the firm characteristics like such as size that have been correlated with the high return in the past and using them to measure market risk. And this is a graphical explanation of risk return analysis of shares. And in this graph we can see that one side they put on risk and other side we can see the return. And in this graph we can to understand that the saving and fixed deposit have low risk and it also have to get the low return. And in next step is to treasure bill is on also have to more risk, therefore they gave and more return. And the cooperative debenture and bonds is also giving more risk and also giving providing and more return also. And the preference shares compared with the corporate debentures and bond is have more risk, therefore they also have to providing more returns. And at the end we can see the equity shares, it is mainly have more risk but it can also have to providing the chance of more return. And this is the end of the presentation, and I believe all you understood the topic. Thank you for your attention, and thank you.